We've undoubtedly lived through some strange times. We'd seen the collapse of communism, the emergence of computer technology, and the commencement of a change in the global economic aspect, back to the times before industrialization, when Asia weighed as economically and politically powerful as the West. In some respects, the present financial meltdown brought all three tendencies to a head: the outward victory of capitalism, the advances caused by digital media, and the expansion of China, and to a lesser extent, India. So in this video, we will be discussing about whether banks will seize your money in the coming financial crisis. Global financial markets. Strength and danger in financial markets have moved dramatically during the last 15 years. New investors have flocked in, and most have had a fantastic journey thanks to the epidemic stimulus. Global markets are tending to tremble as officials apply the brakes. A downturn may be on the way, but it will most likely be moderate. Most millennials and Generation Z have no notion of what it will imply. The United States is suffering from a severe economic recession. As the Federal Reserve's measures to calm inflation substantially cut down economic development, a rising group of experts believe the country could suffer a downturn in late 2022 or early 2023. Stocks have had their most incredible sell-off since June of 2020, indicating that financial markets are considering such problems seriously. However, experts do not assume the decline to be as severe as previous recessions suffered by the younger generation. According to Brett Ryan, a leading US economist at a Dutch bank, the approaching financial crisis will be significantly less dramatic, with only a minor reduction in economic activity. Let's put aside for a moment whether the crisis will be mild or severe, and instead consider whether the banks will seize our money in the event of a financial downturn. Can banks seize your money in the coming financial crisis? So, first and foremost, here's the issue. It isn't your cash. It's not in possession of your funds. When you put cash in a bank, the money becomes the bank's property, and the bank provides you with an IOU. You pay in your IOU and receive money when you retrieve the money. In peacetime, the bank will lend out the amount that you lent to others. Everything will be fine if they repay the money. However, you've got serious issues if the market collapses and the bank can't return your money. In that case, authorities will go to great lengths to ensure that you can redeem your IOU. In the United States, banks are formed with a holding company that offers bonds and an autonomous depositor business that retains depositor funds. In the instance that the bank fails, the depositor's insurance agency will acquire the depositor corporation, auction it off, ensure that the account holders receive their money, and then argue over whatever else the bank owes individuals later. This can occur in a matter of hours. During the financial meltdown in 2008, the CEO of Washington Mutual boarded an aeroplane, and when he arrived, he discovered that the FDIC had confiscated his bank and sold it off. When should we withdraw cash from the bank? Even in a declining market, banks are often the least dangerous location to keep your money. There's no need to withdraw it for safety purposes. But I recall institutions collapsing. What if that occurs once more, you could think, with the Great Recession still fresh in your mind. While uncommon, it does occur, as hundreds of banks did during the Great Recession. You may remember seeing customers forming a line outside their banks asking for their money. Because banks only maintain a portion of savings at hand at any given moment and loan the others out as credit, a concept known as fractional reserve banking, if anyone requests their entire deposit simultaneously, the bank will most likely be unable to keep up with the demand. This is referred to as a bank run. No one aspires to be the last person standing when the bank's financial assets are drained. Therefore, bank runs become self-fulfilling predictions. During the Great Recession, bank runs were an issue and many individuals lost their savings due to bank collapses. Soon after, the Federal Deposit Insurance Corporation, or FDIC, was established to ensure that no other customer misses their insured funds due to bank runs or other institutional failures. FDIC insurance. The best part is that as far as your account is federally insured, your money is safe. The Federal Deposit Insurance Corporation, or FDIC, is an independent organization established by Congress in 1933 to solve the numerous bank failures that occurred during the Great Depression. The goal was and continues to be to increase public trust in the banking sector by protecting consumer savings. All FDIC-insured investment accounts are secured to at least $250,000 per depositor across all account categories. Since the FDIC's inception, not a single dollar of insured deposits has been misplaced. However, not all banks are guaranteed by default, so check with your bank or use the FDIC bank locator. If things go south, how long will it take until you get your money back? When a federally insured bank crashes, the FDIC sells the failing institution's deposits and loans to a surviving bank. Clients' accounts are successfully moved if a sale is completed. Consumers from collapsed institutions will obtain payments from the FDIC for the insured amounts of their accounts within a few days following the bank's closure if no sale can be reached. So, the explanation of whether you should withdraw money right now is simple. No, unless you need it right away. Cash should not be kept at home because it is unlikely to be safe in the event of a fire or robbery. You may always get cash from the fee-free system of over 55,000 ATMs across the country, which you can quickly locate from within the application. Reasons why banks collapse. Bad loans. Along with maintaining depositor money, loans make up a substantial component of the traditional financial operation. Before the latter half of the 20th century, banks typically provided loans to people who purchased houses and to companies for the expansion of their activities. In this field of work, credit analysts' abilities are essential. In this respect, most big banks have extensive training programs for new lending managers, who are trained to analyze borrowers' threats and ensure the bank's assets and revenue. Loan losses will undoubtedly rise when credit standards are reduced to entice more lucrative businesses, causing financial difficulties. High-risk loans to overseas nations, real estate investment trusts, and mortgage corporations have wreaked havoc on banks in the past, leading to their failure. Funding issues. Banks have big accounting records with a lot of assets. Short-term credit, loans, and stock are typically used to fund these assets. A bank may collapse if it has had difficulty refinancing or repaying its debt. General market circumstances can cause funding issues, but they are most commonly caused by investors losing trust in the bank. Asset or liability mismatch. Serious problems can occur when a bank's assets are out of proportion to its liabilities. A floating rate debt financing a fixed interest rate is the most basic kind. If interest rates increase, the bank's debt accrues more and more interest, but the fixed rate loan continues to accrue interest at the same time. This mismatch can lead to significant damage. The consequences of a major chunk of a bank's portfolio being mismatched can be disastrous. Regulatory issues. Foreign banks may be driven out of the market if American authorities blacklist them. This could happen if the bank is in a renegade country or if the bank is involved in criminal activities like money laundering. Proprietary trading. This latest and soon-to-be banned bank operation exposed banks to massive risks. Proprietary enterprises for the most part made a lot of money. However, regulators consider that the risk of enormous losses outweighs the profit potential. Investing in unhedged derivatives, big blocks of securities, exotic products, and illiquid investments was the firm's mainstay. That's all there is for today. Please leave a like and subscribe to the channel if you enjoyed the video. Be sure to click the notification bell to never miss out on future ones. Stay tuned until the next video. See you soon.